You know, money's a funny thing. It looks simple on paper, but in the market, it becomes the most deceptive companion a man can have. You think you're in control, until you're not. Today, we're going to talk about turning $100,000 into $10,000 through day trading. And before you start dreaming, remember, this isn't about luck or tips or fancy indicators. It's about discipline, patience, and a sharp eye for price. Just like I said in the previous video on Take What the Market Gives, the market owes you nothing. It only offers what it wants to, and your job is to recognize it when it does. Now, I've always said a man must trade by his own rules, not by his wishes. With $1,000, most beginners want to swing for the fences. They want to double it in a week, triple it in a month. But let me ask you something. Have you ever met a trader who lasted long by gambling? No, you haven't. Because that kind of trading isn't trading at all, it's hoping. And hope has ruined more traders than bad tips ever could. When you start small, you start honest. $1,000 forces you to respect every cent. It makes you selective, cautious, precise. You can't afford to chase every candle or jump at every rumor. You must wait for your pitch. The market is full of noise, and your job is to find the signal buried inside it. Do you know what that signal is? It's the story the price tells on the chart. Not what you think it should say, what it actually says. I remember sitting in bucket shops, watching the tape roll, trying to catch the rhythm. The same rhythm exists in charts today. Prices move in waves, in pulses. They expand and contract like breathing. If you can't feel that rhythm, you'll always be late or early. Never right. And when you trade with a small stake, timing is everything. You can't afford to be early on a move that doesn't confirm. You can't afford to hold and hope. You have to wait for proof, confirmation. That's where most traders fail. They want action. They can't sit still. They think trading means doing. But real trading, profitable trading, is mostly waiting. Have you ever tried to just sit on your hands and do nothing while everyone else is clicking away? That's the test. That's where discipline comes in, because markets reward patience and punish impulse. Now, some of you are thinking, how can I turn 1,000 into 10,000 if I trade so carefully? That's the wrong question. The right question is, how can I trade in a way that keeps me in the game long enough for that to happen? You see, survival comes first. Profits come later. The trader who lasts, who lives to trade another day, always wins in the end. You can't build wealth by treating the market like a casino. You build it the way a craftsman builds anything worthwhile, piece by piece, trade by trade. You cut your losses small, you let your winners breathe. You study your mistakes more than your victories. Every trade teaches you something if you're humble enough to listen. And humility. Well, that's the hardest thing in trading. The market has a way of humbling every man who thinks he's smarter than it. You must learn to read the tape, the chart, the volume, the reaction to news. Watch how price behaves after it breaks out, how it handles resistance, how it responds to a pullback. Does it hold its ground, or does it fold at the first sign of pressure? The market speaks to you in patterns, in pauses, in failed rallies. Are you listening? Now, don't misunderstand me. I'm not saying you can't grow a small stake. You can, but it won't happen by chasing big wins. It'll happen by avoiding big losses. The math is simple. Protect your capital, and your capital will protect you. Let's say you lose 50% of your stake. You'll need to make 100% just to break even. That's the trap most new traders fall into. They dig a hole so deep, they spend the rest of their time trying to climb out instead of moving forward. That's why your first goal isn't 10,000. It's consistency. It's proof that you can make small, controlled trades and come out a little ahead week after week. Once you can do that, the rest follows naturally. Scaling up is easy once your habits are right. But if your habits are wrong, no amount of money will fix that. Remember what we talked about in Take What the Market Gives. The market doesn't care about your goals. It'll give you opportunities on its own terms, not yours. The trader who listens, who takes only what's offered, is the one who grows his account steadily without wrecking it in a moment of greed. It's not about catching every move. It's about catching the right ones and holding steady when nothing's clear. Ask yourself, can you sit through the dull days without forcing trades? Can you protect your capital when others are losing theirs to impatience? Can you admit when you're wrong quickly enough to keep the damage small? That's what separates the winners from the dreamers. Trading is not about prediction. It's about reaction. You react to what's happening, not what you hope will happen. The market whispers first before it shouts. It gives clues, support that holds, volume that dries up on a pullback, a strong close after weakness. Those are the tells, the subtle hints that something's brewing. A disciplined trader waits for them. And here's another truth. Money doesn't make a trader. Skill does. You could hand $10,000 to a fool, and he'd lose it faster than a careful man could lose 100. But give that careful man $1,000 and time, and he'll grow it the right way. Because he understands risk, he respects the market, and he knows when not to trade. Every dollar you risk should feel earned, because it is earned. And every time you put that dollar in the market, it's working for you, or against you. That's why your capital is more than money. It's your tool, your soldier, your protection. Don't send it into battle without a plan. The challenge from 1,000 to 10,000 isn't about the numbers. It's about the trader you become in the process. The mindset you build, the control you learn over fear and greed. Those are the real gains. Because when you master that, the numbers take care of themselves. So before you take that next trade, look at your chart. Ask yourself, is this the market giving, or am I trying to take? Because only one of those questions leads to survival. Protect your capital first, profits come later. That's the truth every trader learns, some too late, most too painfully. You see, the market is designed to test you. It doesn't care how much you start with, what your goals are, or how badly you want to make it. The only thing it respects is discipline. When you understand that, you stop trading for excitement and start trading for survival. And that's where the real money begins to build. When I say protect your capital, I don't just mean don't lose money. I mean treat every dollar like it's ammunition in a long war. A trader without capital is like a soldier without bullets, useless even if he knows all the tactics. You can have the sharpest analysis, the best entries, and a perfect strategy, but if you blow your stake, you're out of the game. And the market doesn't stop for you. It moves on, leaving you behind, learning lessons you could have avoided if you had only guarded your funds more carefully. A trader's first job is not to make profits, it's to stay in the game long enough to earn the right to make them. Have you ever noticed how quickly traders disappear? They start with energy and confidence, they win a few trades, and suddenly they think they've cracked the code. But one bad streak wipes them out because they never learned the golden rule. You can't play if you have nothing left to play with. When I was starting, I learned this lesson more times than I'd like to admit. I made good trades, yes, but I also took reckless ones. I thought being right was more important than being careful. I was wrong. Being right once doesn't matter if you're broke after the next trade. You must think in terms of probabilities, not certainties. The market is a business of defense, not aggression. It's about keeping what you have while positioning yourself to gain more when the odds favor you. That's what protecting capital really means. It's not fear, it's respect. Respect for the market, for risk, for the math behind survival. Think of it this way, if you lose 10%, you need 11% to recover. Lose 20%, you need 25%, lose 50%, and you need 100% just to get back to where you started. That's not theory, that's arithmetic. And arithmetic doesn't lie. The deeper your drawdown, the harder it becomes to climb out. That's why small losses are essential. They're the cost of doing business, not the end of it. Cutting a loss quickly isn't a weakness, it's strength in disguise. Most traders can't do it because their ego gets in the way. They can't accept being wrong. They average down, hoping for a rebound, convincing themselves the market will come around. But the market doesn't care. It's not personal, it just moves. And when it moves against you, the best decision is often to get out and live to trade another day. Have you ever watched a losing trade and told yourself it'll turn around soon? That voice, hope, is the most expensive voice in trading. Protecting your capital means having rules, not flexible ones, hard, clear, unbreakable rules. Risk only a small percentage on each trade. Set stops not based on emotions but on structure. Where your trade idea is proven wrong, don't widen those stops. Don't justify holding longer because you feel the market will reverse. That's the difference between professionals and amateurs. Professionals know their number before they even enter the trade. Amateurs discover it only when their account balance tells them. Capital protection also extends beyond single trades. It's about managing your mental capital. Every bad loss drains confidence and focus. The more reckless you trade, the harder it becomes to think clearly. And when your mind is clouded, you'll make poor decisions that lead to even greater losses. Discipline preserves not just your money, but your mindset. A trader with both intact can recover from anything. Now, remember what we discussed back in Take. What the market gives, the market offers opportunities, but not all the time. Protecting your capital means knowing when not to trade. There's power in sitting out, waiting for the right setup, for the clean chart that fits your method. You don't get paid for activity. You get paid for accuracy. Every unnecessary trade is an unnecessary risk. Every risk you avoid when the odds aren't clear keeps your capital safe for when they are. Think of trading as farming. You don't plant every day. You wait for the right season, the right soil, the right conditions. You protect your seeds until you're sure they'll grow. Your capital is those seeds. Blow them early, and you'll have nothing to plant when the weather turns favorable. That's why most traders fail. They burn through their resources before the real opportunity appears. And here's something most won't tell you: protecting capital isn't glamorous. It doesn't look exciting on a chart or make headlines. It's quiet, steady, and sometimes boring. But that's the foundation of every big account you've ever seen. Every successful trader started with capital protection. It's not luck, it's longevity. You can't compound profits you don't have, and you can't stay in business if your capital keeps shrinking. Let me ask you something. When you look at your trades, do you see a plan or a series of reactions? Are you preserving your base or risking it for the thrill of quick returns? The difference between a gambler and a trader is that one bets to feel alive, the other acts to stay alive. You want to be the second kind. So before you click buy or sell, before you chase a candle or react to a rumor, stop and ask yourself, how much am I willing to lose if I'm wrong? Not how much you could gain, how much you can lose. Because that single question defines every trader who lasts in this business. The profit seeker comes and goes. The protector endures, growing slow, steady, and unshakable. Trade what you see, not what you hope. That single sentence is the dividing line between the trader who survives and the trader who dreams himself broke. Hope is a dangerous emotion in the market. It whispers in your ear, tells you that you're right when the chart says you're wrong, convinces you to hold when you should sell, and tempts you to buy because something feels like it's about to move. But the market doesn't move on feelings. It moves on facts, price, volume, structure, and behavior. Those are what you see. Everything else is imagination. The biggest trap in trading is believing you can will the market into doing what you want. You can't. No one can. The market doesn't bend to desire, it doesn't reward hope, and it doesn't forgive blindness. When you trade based on what you hope will happen, you stop being a trader and become a gambler. And gamblers don't last. They might win for a while, but the odds always catch up. The market has a way of stripping illusions bare. You can't hide from price. It tells the truth every time. Trading what you see means you're responding, not predicting. You're observing what's actually happening on the chart. The trend, the volume spikes, the reaction at key levels. And you make your decisions based on those facts. You're not guessing where the price might go. You're following where it is going. You're reading the tape as it unfolds, not writing a story in your head. Have you ever found yourself staring at a losing position, telling yourself it'll turn around soon? That's hope talking. And hope has no place in trading. I learned this lesson early, watching the tape tick by. The best traders I ever knew didn't argue with the market. They didn't fight it or question it. They simply followed it. When the price broke out with conviction, they went with it. When it broke down, they got out. They didn't let opinions get in the way. You can't afford to have opinions in trading. The moment you decide what should happen, you stop seeing what is happening. That blindness is expensive. Look at any chart long enough and you'll see a story. The candles, the patterns, the breakouts, they all tell you something if you're paying attention. When buyers step in, you see it in volume and momentum. When sellers take control, the chart weakens, reverses, stalls. That's the language of price. If you listen to it carefully, it will guide you. If you ignore it in favor of what you want to see, it will punish you. Trading what you see requires humility. You must accept that you don't control the outcome. You control only your reaction. The market will always do what it wants. Your job is to observe and align, not to predict or demand. Every time you try to impose your will on the market, you lose a little more control over your account. The traders who last the longest are those who've made peace with uncertainty. They don't chase tops or bottoms. They let the market confirm direction, then they act. You remember what I said in Take What the Market Gives. The market doesn't owe you anything. It offers clues, not guarantees. That same principle lives inside this one. When you trade what you see, you're taking what the market offers at face value. No assumptions, no daydreams, just structure and behavior. That's the closest thing you'll ever get to certainty in trading. The rest is noise. A trader who trades what he hopes sees setups everywhere. Every dip looks like a buying opportunity. Every bounce looks like a reversal. But a trader who trades what he sees waits for confirmation. He looks for strength in trend, follow through in volume, and clean structure on the chart. He waits for evidence before he commits. It's not caution, it's discipline. The less you assume, the fewer mistakes you make. The hardest part about trading what you see is letting go of bias. Bias clouds your vision. It makes you read the same chart differently, depending on what you want to happen. You start looking for reasons to justify your position instead of reasons to close it. You ignore warning signs, average down, widen your stops. That's not trading, that's denial. The market doesn't care about your bias. It doesn't care that you feel bullish or bearish. It only cares about what's happening in real time. The tape doesn't lie. Price moves before the story does. By the time the news confirms what the chart already showed, it's too late. That's why your eyes must stay on the price, not on opinions or headlines. Every trader wants to be early to catch the move before everyone else. But if you act on hope, you're not early. You're wrong. And being wrong too early costs just as much as being late. When you strip away emotion, what's left is clarity. Trading what you see keeps you objective. You're not cheering for your position, you're analyzing it. You're asking, is the market still confirming my idea? If the answer is no, you adjust or exit. That flexibility keeps you alive. A rigid trader, one who trades on hope, breaks when the market turns. But a flexible trader bends, adapts, survives. Ask yourself right now, how many times have you ignored what the chart was telling you because you wanted it to go the other way? How many times have you watched a clean setup pass because it didn't fit your opinion? Every trader has done it. But the ones who learn from it become real traders. They stop chasing predictions and start following evidence. Hope feels good in the short term. It gives you comfort when the market moves against you. But it costs you everything in the long run. The traders who make it understand that trading isn't about being hopeful. It's about being truthful. The chart is the truth. Your job is to see it clearly, act accordingly, and accept what it tells you without argument. Trading what you see doesn't mean emotionless trading. It means controlled emotion. It means you respect the market enough to let it lead. You stop trying to guess the future and start responding to the present. The market is always talking. Read price and volume. They reveal true market intent. Most traders never really learn how to read the market. They look at charts like they're looking at pictures instead of language, but charts speak. Every bar, every candle, every surge in volume, it's all communication. The market tells you what it wants to do if you know how to listen. Price is the voice, volume is the emotion behind it. Together, they tell you the truth that indicators often hide. Price is the raw message. It shows direction, momentum, and structure. Volume is the conviction behind that message. When price moves with strong volume, it means participation. It means traders, big and small, are acting together. But when price moves without volume, it's a whisper, a test, not a declaration. A breakout without volume is just noise. A breakout with volume is strength. That's how you separate real movement from fake excitement. When I first started watching the tape, I realized something: the numbers were alive. They pulsed. When volume expanded and price followed through, you could almost feel the market breathing. The rhythm of buying and selling wasn't random. It was deliberate. Big money never shouts. It accumulates quietly. But if you watch volume closely, you can see the footprints. Those footprints tell you where the smart money has been and where it might be headed next. You ever notice how price reacts after a long, quiet period? A stock trades sideways for days, maybe weeks, then suddenly a burst of volume hits and the price moves sharply. That's not coincidence. That's preparation meeting opportunity. The quiet phase is accumulation or distribution. It's where professionals position themselves before the move begins. The average trader ignores that period because nothing's happening, but the trained eye sees tension building. And when volume finally comes in, it's like a dam breaking. Reading price and volume is about understanding cause and effect. Volume causes the move, price confirms it. If you see rising volume and rising price, that's demand. If you see rising volume and falling price, that's supply. When both move together with strength, it's the market's way of declaring intent. But when they diverge, when price rises but volume fades, it's a warning. The enthusiasm is thinning. You can't ignore that. Have you ever stayed in a trade because the price was rising, even though volume was drying up? That's how many good trades turn bad. The market, like human nature, leaves clues. When buying pressure fades, you can feel it on the chart. The candles get smaller, the range tightens, volume softens. It's like the air goes out of the move. That's your signal. The same goes for bottoms. Real reversals don't happen quietly. They happen when fear reaches its peak, when volume surges as weak hands dump their positions and strong hands step in to buy. You'll see it on the chart long before you hear it in the news. I've always said you don't need 100 indicators. You just need price and volume, and the patience to understand them. Indicators lag. They interpret what price and volume have already said. By the time they flash a signal, the professionals have already moved. But price and volume show you the story in real time. If you learn to read them, you'll always be closer to the truth than those chasing after signals. Now think back to what I said in Take What the Market Gives. The market always offers clues before the move. It never hides them completely. Price and volume are those clues. When you take only what the market gives, you're responding to these signals, not fighting them. You're letting the market show its hand first, then aligning yourself with it. That's the difference between trading with the trend and trading against it. Here's the trick. Don't just look at numbers, interpret them. Ask yourself, what's the story behind this movement? Why did volume spike here? Why did price stall there? When you start asking those questions, the market becomes less mysterious. You stop reacting emotionally and start analyzing behavior. For example, a strong candle breaking a resistance level means little if the volume doesn't confirm it. It might just be a trap. But if volume surges with the breakout and holds through the retest, that's confirmation. That's strength you can trust. Price and volume together are like a heartbeat monitor for the market. They show you when momentum is strong, when it's fading, and when it's about to shift. You can't see that with guesses or feelings. You can only see it by watching the data. The market never lies. It just speaks a language most traders refuse to learn. They chase rumors, follow opinions, ignore the tape, and wonder why they lose. When you align yourself with price and volume, you start seeing what others miss. You begin to sense when something's changing before it becomes obvious. A sudden burst in volume on a quiet day. A failed breakdown with heavy buying pressure. A new high that doesn't bring in more participation. Those are signals, the market whispering to you. You don't need predictions when you have observation. Ask yourself, what's moving the price right now? Emotion or conviction? Are traders chasing or committing? The volume will tell you. Price can deceive for a while, but volume reveals intent. That's why when price rises on weak volume, I never trust it. It's built on air. But when volume expands and price follows smoothly, I know the move has substance behind it. That's the kind of movement a trader wants to be part of. The real art of trading lies in patience, waiting for confirmation. You let price and volume prove themselves. You let the market show you that real money is stepping in. Because when the professionals move, they don't hide it. Their footprints are visible in the form of steady volume increases, tight consolidations and clean breakouts. You just have to train your eyes to see them. Every chart is a story of conflict, buyers versus sellers. Price tells you who's winning. Volume tells you how badly the other side wants to fight back. When both align, that's conviction. When they don't, that's confusion. You must avoid confusion like poison. The clearer the alignment between price and volume, the higher your odds. It's not magic, it's observation and discipline. Price shows you where the market's going. Volume shows you how much strength is behind that move. Together, they're the market's heartbeat, the only two truths that matter in a world full of noise. Accept small losses quickly to avoid large ones. Every trader hears that line, but very few live by it. The reason is simple: losses hurt. They bruise the ego, they sting the pride. They make you question your skill. But if you plan to survive in this business, you must learn to treat losses as normal, expected, and even necessary. The market isn't a place for perfectionists. It's a place for realists. You will be wrong often, and that's fine, as long as your losses are small. The only kind of loss that destroys traders is the one they refused to take when they had the chance. A small loss is a tuition fee. A big loss is a life lesson written in red ink across your account. When you take small losses, you're paying for information. You're learning how the market behaves, where your setups fail, and where your discipline cracks. Each small loss is like a checkpoint. It tells you something valuable if you're willing to listen. But when you let a small loss grow into a big one, you stop learning. You start hoping, and hope is a trader's most expensive emotion. The market punishes hesitation. The moment you realize your trade is wrong, you must act. You can't negotiate with price. You can't reason with it or wait for it to change its mind. Price doesn't care what you think, it just moves. A disciplined trader cuts the loss and moves on. A hopeful trader widens the stop, adds more to the position, or prays for a reversal. You ever found yourself doing that, justifying a losing trade because you know it'll turn around? That's not strategy. That's ego in disguise. When I was young, I learned that the best traders aren't the ones who make the biggest wins. They're the ones who lose the best. They're the ones who can take a loss without flinching, without anger, without trying to get it all back in one swing. They see losses as business expenses, not personal failures. You can't run a trading business if you can't handle expenses. Small losses are the cost of staying in the game. There's a rhythm to successful trading, a flow between taking risks and protecting capital. You step in when the odds favor you, and you step out the moment they don't. That's how you preserve your capital long enough for the real opportunities to come. Think about it. Every dollar you save from a big loss is another bullet you can fire at a better setup. Protecting your stake is what allows you to compound over time. Letting a single loss spiral wipes out weeks or months of progress. Accepting small losses also means accepting imperfection. You will never catch every top or bottom. You will never have a 100% win rate. But you don't need one. All you need is a system that wins more than it loses in dollars, not in trades. That's why small losses are not failures. They're part of a statistical edge. Each small loss keeps your average outcome positive over time. The moment you try to avoid losing altogether, you start taking oversized risks, and that's where destruction begins. The biggest danger in refusing to cut losses is not financial, it's psychological. A big loss changes how you think. It shakes your confidence, clouds your judgment, and makes you hesitant on the next opportunity. A trader who's carrying emotional baggage from a large loss is half blind. They second-guess setups, exit too early, or overtrade trying to make it back. The only way to stay clear-headed is to keep losses small enough that they never have emotional weight. Remember what I said in Take, what the market gives, the market offers chances, not guarantees. When the market takes away, you let it. You don't fight back with revenge trades. You take the small loss as part of the game and wait for the next hand. The traders who last understand that surviving today matters more than winning today. One bad trade won't kill you, but one undisciplined trade that turns into a disaster can end your entire run. Most traders lose because they turn trading into a battle of pride. They can't admit they're wrong. They'd rather defend a bad position than accept defeat. But the market isn't a debate. It's a scoreboard. Every tick tells you who's right and who's wrong for now. And when you're wrong, the fastest way back to being right is to exit and reassess.